to the Money RX for CRNAs podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetist along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome to Money RX for CRNAs. If you caught last week's show, you know I was talking about Social Security and some of the nuances and the importance of that program. And that episode was the first part. And today we're going to finish our little two-part mini-series on Social Security. And so today I'm going to specifically talk about when to begin retiree benefits and how to best understand spousal benefits when it comes to Social Security. And like last week's episode, I promise I will do my best to keep this episode light, as the topic can be confusing. But again, ultimately my goal is to, at the very least, give you a high-level understanding of these Social Security topics, so that you feel just a little bit more confident, more clarity, as perhaps you think about your future use of Social Security, and especially using it as a foundation to your retirement income plan. So here we go. When your Social Security benefit is calculated, it's done in a way that's age neutral. In other words, if a CRNA lives until her exact life expectancy, there is no benefit to delaying receipts of benefits or advantage to starting late. All will be equal. But determining a CRNA's longevity, however, is one of the big unknowns in retirement planning. And given this unknown, it is just really difficult to determine the ideal start date. Now, that being said, the decision about when to begin receiving Social Security retiree benefits may be the most significant decision in the retirement income planning process as a whole. So since it's so important, I always counsel clients to frame this decision as an insurance decision, because Social Security works like an annuity. It provides needed protection against longevity risk or the risk of outliving one's money. In fact, Social Security could be the best annuity out there on the market because it is inflation adjusted and is guaranteed by the government. But again, if you're a listener, you've heard me say this already. Personal finance is personal. So this is not a one-size-fits-all decision. CRNAs need to consider a number of factors, including whether they are still employed and will be impacted by the earned income penalty, which I'll talk about in a minute, or their marital status, their health, personal wealth, personal risk tolerance, and investment savvy will also need to be considered. Okay, so when is it best to claim Social Security early? Well, first and most importantly, some people will have no choice to begin their Social Security benefits at age 62 due to their lack of other sources of income. There is a huge challenge of funding the gap years between retirement and the beginning of Social Security benefits that cannot be underestimated. CRNAs need to balance the positives of buying a larger inflation-adjusted income in the future with the need for current income. And while others are hesitant to spend down their retirement savings early in retirement, as that will result in less liquidity or cash available in their later years, and they will have less money to leave to their heirs. So some CRNAs, due to poor health, are not concerned with protecting against longevity. And so starting benefits at age 62 makes the most sense for them. And when is it best to delay Social Security? Well, aside from the obvious benefits associated with increased payments due to accumulation of your delayed retirement credits, deferring receipt of Social Security income has a number of additional benefits. One example is the compounding cost of living adjustments, or COLAs. Another example is the reduction in one's overall investment risk and investment expenses because self-managed investment accounts are drawn down early in retirement. Delaying can also be a tax-savvy strategy, as we will see in a minute. Let's talk about estimating life expectancy and how that works. According to data from the Social Security Administration, a man reaching age 65 today can expect to live on average until age 82. A woman turning age 65 today can expect to live on average until age 85. About 1 out of every 4 65-year-olds today will live past age 90. And about 1 out of every 10 65-year-olds will live past age 95. And you can get an estimate of how long you're likely going to live by using the life expectancy calculator on the Social Security website. But remember though, I don't want you getting upset. Remember, these figures are just averages. 50% will live beyond these averages. And these figures also do not take into account factors such as your current health, your lifestyle, and family history, all of which obviously could increase or decrease life expectancy. And there are other websites out there such as livingto100.com and bankrate.com that allow people to do a calculation that accounts for lifestyle factors. And when you're evaluating life expectancy for a couple, you always want to plan for the partner who is likely to live the longest. The probability that one member of a couple will reach 92 is greater than 50%. A percentage, again, that doesn't take into account lifestyle factors that would push it even higher. When we're working on this with our clients, what we first try to do is to get their break-even age. Now, the break-even age is the age at which the total value of the higher benefits the CRNA will receive from delaying benefits starts to exceed the total value of the lower benefits he or she will receive if they start early. For most single individuals, ages 70 to 80 are the most common break-even ages. And again, this estimate of break-even is based on average life expectancies. If after doing a break-even calculation based on our client's personal life expectancy, that we think he or she will live beyond that age, well then it would make financial sense to delay their benefits. On the other hand, if our client has a reduced life expectancy, the net present value of her total expected benefit will be greater if she started early. Now, like many things, this break-even approach, while useful, does have a number of issues. The first is the obvious fact that we cannot know for certain our client's life expectancy. Does our client's spouse have a need for a survivor benefit? If that's the case, maybe delaying to increase this benefit makes sense regardless of the client's life expectancy, which is a consideration ignored by the break-even approach. And this approach also ignores the insurance component of Social Security and the benefits associated with transferring one's longevity risk. And finally, what discount rate should you use in the calculation? Even a small change in this number can have a big impact on the ideal claiming age. And I'll talk about this more in a minute, but when evaluating life expectancy for a couple, you always want to plan for the partner who is likely to live the longest. And this is because the higher earner's benefit doesn't stop until the death of the second spouse. So you will want to maximize this benefit by delaying your receipt of the higher earner's benefit until after full retirement age, ideally until age 70. And this is especially true if money's going to be tight for the surviving spouse. And I mentioned earlier the earned income test. Let's talk about that. For those who are still employed beyond age 62, delaying receipt of benefits also makes sense due to this earned income test. Now, the test impacts those who begin their Social Security benefits before full retirement age and have earned income, meaning you still have a job, in excess of a certain threshold limit. And for Social Security, earned income means wages and net earnings from self-employment. Investment income, pensions, capital gains, and inheritances are not included in this definition. And for 2024, those who are under full retirement age and working will lose $1 in Social Security benefits for every $2 earned above the earnings cap of $22,320. And in the year in which the worker reaches full retirement age, this reduction is reduced to $1 for every $3 earned above the earnings cap of $59,520. And then finally, once the worker attains full retirement age, he or she may continue to work and earn money without it impacting their Social Security benefit at all. So when we work with our clients from a financial planning perspective, the best way to avoid the earnings limit is to delay receipt of Social Security benefits until full retirement age, if possible. As I mentioned earlier, some clients will have no choice but to begin the benefits as soon as they are eligible. But if they do have other savings and are still employed, it would probably make sense to use these savings to bridge any income gap and to delay receipt of Social Security. Now, how many of you think that Social Security is taxed? Well, the answer is it depends. But more than likely for CRNAs, your Social Security benefits will be taxed. But ultimately, Social Security benefits are subject to taxation only if the worker's total provisional income exceeds certain thresholds. Now, provisional income is another keyword, and this is calculated as your adjusted gross income, not including any Social Security, plus non-taxable interest, plus 1/2 of Social Security benefits. And depending on his or her provisional income, the worker could pay tax on up to 50% or even 85% of Social Security benefits. Benefits are tax-free if the provisional income is less than $25,000 for those filing as single or head of household, or $32,000 for those who file a joint return. Let me say that again. The benefits are tax-free if your provisional income is less than $25,000 for single or $32,000 for those who file a joint return. If the provisional income is between $25,000 and $34,000 on a single or $32,000 to $44,000 on a joint return, up to 50% of Social Security becomes taxable. And then finally, if provisional income exceeds $34,000 for singles and $44,000 for married couples, then up to 85% of your Social Security benefits becomes taxable. The silver lining, regardless of your provisional income, is that 15% of your benefit will always be tax-free, guaranteed. And with few exceptions, Social Security benefits are not taxed on the state level. If I haven't lost you yet, let's talk now about Social Security spousal benefits. The availability of Social Security spousal benefits does indeed date back to the origin of Social Security. Again, they were meant to provide a source of retirement income for non-working spouses. So the spousal benefit allows one spouse to receive benefits based upon the other spouse's earnings history. And a spousal benefit is most often claimed when it exceeds the spouse's own work benefit. Now that's kind of confusing, so let me try to break that down. In its simplest form, a spousal benefit will pay a spouse with a low or no earnings history a maximum of 50% of the primary earner's benefit. A current spouse married at least 1 year is eligible for spousal benefits, as is a former spouse if the marriage lasted at least 10 years. And as we've already talked about, workers must be age 62 to claim benefits on their own earnings record. Well, this is true of spousal benefits as well. A spouse cannot begin to claim until age 62. So let me show you a few examples of how spousal benefits work. Let's say CRNA Mindy, age 66, has reached her full retirement age and is eligible for a worker benefit of $500 a month. Her husband Matt has a PIA of $1,200 a month, making Mindy eligible for a $600 spousal benefit. Remember, 50% of the higher earner in the marriage. Her benefit will be calculated as follows. She will draw the full $500 based on her own record, and an additional $100 will be added to her payment from Matt's earning record. And an important thing to know, there is no delayed retirement credits to a spousal benefit. So here's another example. CRNA John has reached age 66, his full retirement age, and he is entitled up to 50% of his wife's PIA, which is $1,000 per month. If John were to delay receiving the spousal benefit until he reached age 67, well, he would still be receiving a $1,000 monthly benefit. So there is no advantage or reason to delay receiving a spousal benefit past full retirement age. Let's bring this topic home now and talk about a few filing strategies for married couples. Does it pay to delay? As we've just seen, retirees who start receiving their Social Security benefits early will receive more payments, but at a reduced rate. Starting later, up until age 70, means fewer payments, but at an increased rate. Whenever possible, one should at least wait until full retirement age to begin. Why? Again, at full retirement age, individuals are entitled to their full retirement benefit, or PIA. In addition to that, the earnings cap disappears at full retirement age, so one may continue to work if they choose while collecting Social Security benefits with no reduction in benefit. Postponing benefits effectively guarantees the retiree an 8% annual return, a rate that will be hard to beat, particularly in today's volatile market environment. So for a retiree that delays claiming their Social Security benefit until age 70, that equates to a monthly check that is 76% more than if they claimed when they first became eligible at age 62. So why then do more than half of all Social Security recipients claim their benefits at age 62? Why do only about 3% wait until age 67 or later? Because of the cumulative effect of delaying for multiple years only compounds the effect for those clients who live well past life expectancy. Social Security will continue to represent the largest asset for the majority of retired Americans. And as our population ages, it is going to be critical for you as a future retiree to be familiar with the options available for maximizing this benefit. The Social Security Administration will not provide counseling to retirees on their claiming decision. So if not, I strongly encourage you to work with a certified financial planner like us to educate you. There is no simple answer to when is the correct time to claim Social Security because we don't know how long we're going to live. And the use of the break-even analysis is only as useful as your prediction about your life expectancy, a figure that most people tend to underestimate. When all is said and done, the best way to make a claiming decision is to incorporate it into an overall retirement income plan. You need to focus on the issue of increasing longevity and understanding to weigh losing out on payments up front against the possibility of running out of money later in retirement. Keep in mind that delaying Social Security does not mean that one needs to delay retirement. The decision to retire and the decision to claim Social Security retirement benefits are two separate and distinct decisions. So I hope you found today's episode helpful as you think about your retirement and when you should turn on your Social Security retirement benefits. Again, given that everyone is different and everyone has unique needs and circumstances when it comes to retirement income and Social Security planning, it is nearly impossible for me to cover everything in this podcast episode. So if you have any unanswered questions about your retirement income or your Social Security benefits, or maybe just need a recommendation or a resource, please don't hesitate to reach out. You can shoot me a note directly. My direct email is brett@oakcapitaladvisor.com, or you can directly schedule time with me by going to our website, oakcapitaladvisor.com, and click the free pre-op assessment link where you can schedule a call with me at your convenience. And take a minute too and give this show a review on iTunes or wherever you listen to your podcast. We'd really appreciate that. It really helps the show, and that would make it easier for other CRNAs to find us when they're searching for podcasts. Thank you again for listening to this episode of Money RX for CRNAs, and have a great week.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.